Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by Barnes Creative Studios. Check them out for video services, for drone services, for walkthrough videos. They also can make your videos ADA compliant. Just check them out. They do great work at barnescreativestudios.com. And that's plural. All right, we have a great show for you today. You know, one of the things that I think we're all going through in the commercial real estate industry right now is we're in the mid-year of 2022 is what the heck's going on, right? There's interest rates kind of going up very quickly with promises that they're going to go up more. We have inflation is still kind of running away. You know, we have wars going on. We have supply chain issues. So what should we expect moving forward for real estate transactions and pricing and cap rates and that sort of thing? Well, we're in luck. Please welcome my guest, is Tim Bodner, and Tim is a partner with PwC. Tim, good to see you, sir.
Good to see you, Michael. Thanks for having us.
So you guys just completed your 2022 PwC Midyear Real Estate Deals Outlook, and Tim, I think people are kind of curious, kind of what. You know, when you look at the transactions, kind of, I guess maybe we take them overall or we go in the beginning, but then we'll go into some different sectors. But when you look at deals starting at the beginning of the year and you get through where we are today as we're doing this show, we're in June of 2022. Are you seeing any trends yet on cap rates or pricing adjusting any at all?
Yeah, look, Michael, our hypothesis moving into 2022 was that we would continue to see an acceleration in deal activity. And certainly as we went through the first quarter of this calendar year, deal activity across the board was up significantly. We saw a resurgence in sectors that have been quieter for some period of time, particularly the retail sector, as well as hospitality and leisure. And so Q1 was quite robust. As we shifted into the second quarter and some of the macro items that you mentioned started to come into the operating environment, certainly there's been an adjustment in some market participants' behaviors in terms of their willingness to do deals, or whether or not deals actually pencil because of where financing costs were, as an example. So certainly all those things that you mentioned are playing an impact, but we still are seeing, even as we close out the second quarter, robust transaction activity.
Yeah, well, that's interesting to see. You know, we sell investment properties here at our shop, and we are starting to see buyers adjust their underwriting, but you know, depending on the sector, it seems like it's having less impact, right? Because if you're going to adjust your underwriting for higher rates, and the next buyer is not, guess who's going to win that deal, right?
That's right.
Well, Tim, let's look at some of the sectors and kind of what you're seeing as trend and what you expect moving forward. And I think you had mentioned retail was a little bit maybe surprising results.
Yeah, look, I think for a while thematically, we saw a number of the large institutional investors have interest in grocery anchored retail for the reasons that are intuitive to most in terms of the resiliency of the tenancy, the necessity based of the product. And so I think what was surprising to us was how much of an impact smaller investors had inside the retail sector, and in a way that's wider than just grocery anchored centers, particularly in those markets that kind of are have a more of a remote orientation to them. And what we're hearing from some market participants is they view that over time, when you look at it on a relative basis, that those opportunities will become more attractive, and they're trying to get ahead of larger institutional investors. So I think thematically in retail, more activity than we see. It's up, over 20%. And it's not just grocery, but it's across the board.
And what would you expect moving forward for retail deal activity as interest rates continue to climb and inflation still is here as an issue?
I think what's been shocking, and shocking might be too strong of a word, but I think what's been most interesting to us, and if we go back to the beginning of 2020 as we started moving into the pandemic, I think there was a wide view that people's behaviors would substantively change, and that would ultimately impact, the applicable real estate. It's not just true here, but it's true in industrial and logistics. It's true in hospitality and leisure. I think what we've seen in retail is that people still want that omnichannel experience. They want to be able to go and touch and feel the product. They want to have an experience, and so our view is that we think those things are going to continue to play an important role in what happens long term with retail real estate. Now, having said that, I think we've been well quoted on this, that the United States is, when you compare us to other countries around the world, we're over retail here. And so it's not to say we're not going to continue to see more activity in terms of malls being repurposed and like, but on balance, retail is performing better than I think most would have anticipated.
And what would you anticipate for cap rates moving forward in the retail world?
Yeah. Look, I think that the jury on cap rates is still out. Certainly there have been pricing adjustments that have come in, but what we would say is they're more transaction specific. I think that what's interesting about the debate on cap rates holistically right now is what's going to happen from a numerator perspective in light of the more challenging operating environment. Certainly, the denominator gets a lot of attention because of the movements in interest rates and the like. But I think and you covered this in your comments a bit ago around how do you underwrite deals. I think how do people think about future growth is where there's a lot of time being spent. And so ultimately, how those two things interact with one another will over time play into where cap rates move.
Yeah. Okay. Well, let's jump to industrial, because it seems industrial has really been hitting on all cylinders. But there was some recent news from Amazon, right?
Yeah. Look, it's been heavily reviewed and analyzed by a number of market participants. I think what we're seeing across our clients that we interact with in the transaction is that some of that adjustment in their real estate strategy, as well as others' real estate strategies, was already somewhat being adjusted. But the notion that is going to dramatically impact long-term activity in the logistics sector, the overall appeal to it, we're just not seeing. I think the other thing that's quite interesting in this particular space is we're starting to see variants of logistics coming into fruition that we're always out there, but it seemed to be quite prominent now, and that's in and around indoor and outdoor logistics. And you think about the available space around ports and things like that, particularly given the continued challenging setup around the supply chain. We're starting to see a number of market participants being quite creative in how they think about logistics. And so how those two things kind of relate to one another, leads us to continue to believe we're going to see, continued activity. And look, we just saw a very large transaction announced, a week or two ago in the space. And, there, I think, is a good example of how bullish people continue to be in and around logistics.
Yeah. You talking about the Prologis deal?
Yeah.
Yeah. Okay. Well, let's jump to another sector that has been going through some changes, and that's hospitality and leisure.
Yeah, look, we've across the board seen market participants in the hospitality and leisure segment be quite optimistic about the world as it exists today. And it's not just the hotel related businesses, but we're seeing it in cruise. We're seeing it in alternative accommodation and the like. And so, look, the activity is up above 30%. I think it's closer to double that in Q1. The trends in RevPAR and how much pricing power these businesses have today is, quite substantial. Clearly, still a theme towards leisure related activities as people want to get out and visit with one another and take vacations and the like. But even the group and the business travel, what we're hearing from our channel checks is, that is coming back. Still some time to where it gets back to where it was before, but the activity is strong. And when you look at forward bookings throughout the summer, across the board, folks are quite optimistic, and so we do think that we're going to see more activity in the deal sector and broadly across hospitality and leisure.
Yeah, it's nice to see some of these conventions and meetings happening again, isn't it?
It is. I mean, look, it's we talk about it in the report, but what's interesting is there's an acceleration in services spending, and if you think about how that acceleration flows through to what we're talking about now, there's a case to be made that could further surprise to the upside versus the other direction. Now, as we all know, hospitality is not a leading indicator, and so there is a bit of caution that needs to be placed in the sector. But overall, at the moment, the mood we're hearing, what we're seeing in terms of pipeline and like is a favorable operating environment for hospitality and leisure.
Yeah. We're talking with Tim Bodner, partner with PwC, about their 2022 mid-year real estate deals outlook. And another property sector, Tim, that's been really exciting, a lot of people doing transactions, is the multifamily world. Are you seeing any trend there as you look at it mid-year, and what do you expect moving forward?
Yeah, look, the trends across residential real estate broadly, multifamily being one, I would put student housing in there as well, is very, very strong fundamentals and a significant amount of interest in the sector from a wide variety of investors. We're continue to be bullish on what happens from here. We think there's some incremental tailwinds that are going to play into the setup just due to what's happening in the for sale residential market. I don't think it's lost on anyone that the rising interest rate environment and the impact on affordability, the continued challenges associated with supply only add to that. And so we do think and are seeing continued robust activity across residential related themes.
Yeah, multifamily's been really, really on a roll, and it almost seems like the multifamily market is seeing such high rental increases each year that it be the sector that's least impacted on deal pricing and cap rates because of higher interest rates?
Yeah, look, I mean, there's a significant amount of capital that's being allocated towards multifamily and wider residential themes. And so if you think about the impact of that capital on the overall cap rates, there's certainly substantive evidence that cap rates in core multifamily assets don't move as substantially as maybe some may think.
Yeah. All right, now let's move to the sector that some people believe is most in question, and that's the office sector. What are you seeing for trends there, and what are your expectations?
Yeah, look, I think the office sector is going to be is what some believe is a kind of a K-shape effect or a story of have and have-nots. There's certainly a flight to quality throughout office, and those office assets that create an overall better experience or have, certain levels of certification from an ESG perspective. Assets like One Vanderbilt in New York is one example of that. There's tremendous interest, and we're seeing broad-based investor interest from investors across the globe in and around those types of assets. And we think we're going to continue to see that as we move it throughout the rest of this calendar year and beyond. The story is really on the Class B and below office assets, and there are headwinds there that will need to get worked out over time. Just I think everyone's trying to sort out the level of capital that's required to reposition some of those assets, make it a more challenging asset class. And so we do think office is going to be a story of have and have-nots. Look, on the office utilization front, we think office is going to continue to be a story of flexibility. I think the trend of people spending 3 to 4 days in the office versus 5 is here to stay, and so that utilization will clearly be impacted by that. But is that going to cause the significant adverse effects that some have commented on? We don't think that's going to be the case over time.
So what do you think, and maybe this is the personal view for you, but what do you think about Elon Musk's statement to his Tesla employees, hey, get your behind in the office 40 hours a week or get out of here? What do you think about that?
Well, look, I think the notion that people are more creative and collaborative inside of an office environment, I think is undisputable, and certainly in a wide variety of businesses that's true. And so, people do need to, I think, accept that there's not going to be a world of complete remote work. But on the other side of that coin, and certainly it's part of our strategy here at PwC, the idea of giving people choice in and around how they're spending their time, we think is long-term here to stay, particularly when you consider just how competitive it is out there in terms of talent.
Yeah. Well, you mentioned ESG and the flight to quality. So we just took out to market a AAA credit single tenant building, LEED Gold, beautiful, very mission critical tenant in the $47 million range. And it's really interesting to see, some of the buyers in the space. So it's like, you know what, we're going to be a little cautious on office right now. We're going to be acquiring less. And then some folks will say, wait, this is mission critical, that we're not concerned about it. And then the folks that are kind of in the camp of, all right, this may be the window of opportunity where people, we have less competition to buy office, and maybe it's a time to acquire deals. So would you expect deal activity? Have you seen deal activity already slow down, and what do you expect?
In terms of the higher quality office, or as you framed it, Michael, the mission critical assets, and you can make that same comment when you think about some of the content creation and creative industries, as well as things like life sciences and the like. We're seeing some market participants, kind of increase the level of their activity because they do view it as an opportune time and a less competitive time. On the other side, there's some market participants that take a differentiated point of view. But overall, we think the office story is a story of quality, and we think that's what's going to drive activity throughout the rest of this year.
Yeah, and we're talking with Tim Bodner about their report, the Real Estate Deals Outlook, Midyear 2022. And Tim, as you guys did this report and put it out, and by the way, we'll have a link at the show website to the report, so you can go check it out yourself. It's creshow.com. But Tim, when you did this report and you guys did this study, kind of what jumped out to you as maybe surprised you or maybe didn't expect?
Well, look, so I would frame three things for you, Michael. Number one is between August of 2020 and May of 2022, there were 42 REIT transactions, and roughly 70% of them were public to private, and 30% were public to public. But the volume of that activity was in excess of what we expected moving in to 2022. So that's the first thing. The second thing would be the broad-based interest in retail that we were speaking about earlier. The notion that smaller investors would increase their level of their activity was a surprise to us, as relative to when we put out our outlook at the end of last year. And then the final thing is just what we're seeing in hospitality and leisure, and the increased interest in experiential related real estate across the board. So we're seeing a uptick in the level of activity around golf courses. We're seeing an increase in level of activity around marinas. We're seeing activity in and around ski resorts. And so this whole kind of experiential, the increased role that experiential real estate is playing presently, is a surprise to us. We always thought it was there, but I think the level of activity was more than what we had thought.
Yeah. And as you look at the real estate deals outlook, so and you look at all the property types and price and size deals that you guys considered here. So is it fair to say that then overall the activity has still just been really good? It's been really strong. Tell me if I'm wrong there. And then as you look forward, what do you expect on the amount of volume of activity?
We continue to think that we're going to see robust deal activity as we move forward from here. Look, Q1 was quite strong. 2021 was quite strong. So, look, the nature of real estate transactions, as everyone knows, tends to be sporadic. So, quarter to quarter, are we going to see peaks and valleys? We certainly think that's going to be the case. Do we certainly think that we're going to see some buyers and some market participants stay on the sidelines because of the setup that we're all dealing with? We certainly believe that. But on balance, we think that we're going to continue to see robust activity, and the reason for that is really a couple of things. We continue to see incredible amounts of capital moving into real estate from the retail channel into the non-listed real estate sectors. Some market analysts put out an estimate that sector on an NAV basis is about $100 billion sector. At the end of May, on a levered basis, it's closer to 200 billion, and there's a number of large institutional investors moving into that space. So we think the impact of all that capital will be quite substantive is the first thing. The second thing is, when you look at kind of closed end or opportunistic real estate funds across the board, it's been well analyzed that there's more than 300 billion of dry powder sitting on the sidelines. There's something like 1,300 funds being raised in the market, some by large market participants that are quite substantial, but there's a lot of, and look, the more challenging operating environment is conducive to the deployment of opportunistic real estate capital. So we think that's going to play an impact. We think what we just talked about around experiences and the rotation into services will bring deal activity. And then finally, just the idea of not just what we're seeing in real estate, but we're seeing it across all of the sectors that we cover here at PwC. There's just a growing importance of scale and advantage of that, and we think that's going to be a catalyst for transaction activity as well.
Well, Tim, I've got to tell you that as a commercial real estate broker that owns a firm that is based on 90% of our business is on investment sales transactions, I feel a lot better now after talking to you.
Look, I mean, there's challenges out there, Michael, but I think one of the things that we've always seen within real estate, throughout cycles is just how resilient people are and how creative they can be. And so we think that's going to be what carries the day. And so certainly challenges to deal with. There's headwinds out there, but focusing on what you can control and being creative and resilient is what we focus on and what we're seeing folks we interact with focus on as well.
Yeah. Well, what we're seeing on the different sectors kind of deal-wise day to day here that, these sales, aren't going to hit the books, right, for a month or 2 months or 3 months is on these retail and the office and the senior housing, we're seeing sellers adjust their thinking on valuations. And so as people ask me sometimes, well, are the sellers sticking with their prices of a year ago, or are buyers still paying it? In those sectors, I'd say overall it's different for every property, obviously, but we're seeing sellers are saying, all right, we get it, cost of funds, let's adjust our valuations. But industrial, multifamily, not seeing it yet. Sellers are like, nah, the rent increases are too high. I don't think we need to adjust our values just yet.
Yeah, so I mean, look, it's like anything. There's always going to be exceptions, and there's people are going to have to recalibrate expectations and how they think about the world. But we continue to be, as I mentioned, optimistic.
And we're also seeing lots of buyers in the market, as you mentioned, a lot of dry powder and a lot of capital looking for deals, even in the sectors where some folks think, like office, some people think maybe a B office building is not a place to be. But I tell you, there's a lot of capital. We're selling office buildings very well right now. And because I think, one man's trash is another man's treasure, right?
You got it.
There you go. Well, Tim, any final thought related to the outlook for our audience?
I think the thing that we think is going to be the story when we come back to you is it's going to be a continued story of the impact of retail capital moving into real estate. It's a strong trend that's reshaping real estate. So I think if I leave folks with one comment, it's that's one space to watch quite carefully here as we move throughout the rest of this calendar year and into the next couple of years.
Yeah. Well, great. Again, I feel better after talking to you, Tim. Thank you for being with us, sir.
Thanks for having us. Always appreciate it.
All right. And thank you for joining us around the country. As we mentioned, we'll have a link to the actual report for you at our website at creshow.com. And hey, we do appreciate hearing from you. We really appreciate the kind words about the show and rating the show and sharing the show with others and paying it forward in that way. So thank you for that. And until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Buxton. Take leasing, site selection, and due diligence to the next level. Make the right decisions with on-demand mobile data. Visit buxtonco.com. By Bull Realty. For proven commercial real estate asset and occupancy solutions, contact me. My email is michael@bullrealty.com. By Commercial Agent Success. Expert level commercial real estate broker training. Cloud Access 1 up to 21 one-hour videos. Visit commercialagentsuccess.com. Thank you for reviewing, subscribing, and sharing America's Commercial Real Estate Show.